Hello, Professor Rex here. We are now 109 weeks into our classroom stock portfolio where we invest $12.50 weekly into 10 different dividend-paying stocks. It was another great week for the portfolio, boosting the annual return to 20.05% per year. Now, don't get too excited. It's highly unlikely we can sustain a return that high. Otherwise, we'll all be quite rich very quickly. Remember, historically, stocks average 10% a year. In this week's video, I've added a slide about the stocks we sold this week, and we don't often sell. I also added a slide comparing our portfolio's performance versus a very popular exchange-traded fund that only holds dividend-paying stocks, so it's a good apples-to-apples comparison. And there are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. Oh, also, for the first time, I'm updating our technology portfolio. An interesting thing to be aware of that's going on now, publicly traded stocks, which comprise this portfolio, are required to release their balance sheet, income statement, and statement of cash flows every quarter. And we are at the time of the calendar when most companies are releasing these financial statements. So expect our list of best stocks to buy to change more frequently. Now, if you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting 2 years ago, each Monday I invest actual real-world money, the equivalent of $50 a month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. In 2022, the market didn't perform well, but in 2023, stocks took off. Currently, the stock's value is over $1,719. The portfolio's return has been 20.05% per year, which I mentioned, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.18% per year, but for non-dividend-paying stocks, average return has been negative. The study seems to be updated each year, so go check out the source link that I included at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that increase their dividend recently. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? We'll talk about that on the next slide. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, equivalent of about $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with only $12.50 a week. Originally, I invested $25 per paycheck for this portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement account, my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. And for our classroom stock portfolio in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week for year 2. In year 3, which is now 2024, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81. Now let's get to some new stuff. A very popular exchange-traded fund, in other words an ETF, that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF. No one calls it that. They all call it by the ticker SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is $1,719.10. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's value would only be $1,493.26, which is a difference of 15.1%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio's stocks. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. SCHD has, at times, had large positions in stocks that I consider to be value traps, something you want to avoid. This slide shows our best performing stocks based on when they were initially purchased. Stocks in yellow have been sold. New to this slide are two companies in the industrial machinery and supplies and components industry, and those are Crane Holdings and ITT. Also remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's look at the column called strategy. And specifically, there's a category called dividend growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. Now the other 10% of investments so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually much smaller companies, and there's less information about them. But studies have shown that they historically beat the market averages by a significant amount. So we're giving those stocks a try too, even though they're riskier. This slide shows our best performing stocks this week, ranging from nearly 11% to 5%. And of course, as we said earlier, our portfolio had a great week. Several of our companies released a quarterly balance sheet, income statement, and statement of cash flows this week, as they are required to do on a quarterly basis. Best performers this week are Cigna, Crane Company, which is diversified machinery, ITT, which manufactures industrial brakes, pumps, valves, etc., MasterCard, which everyone knows, Norfolk Southern, which is a railroad in the east, and Wesco, which is similar to Grainger. Now, we don't often sell stocks in the portfolio, but this week we sold two. We sold United Rentals, an under-the-radar dividend payer, and Williams-Sonoma, a dividend growth stock. United Rentals provided us with a 37.9% return on our initial investment, while Williams-Sonoma gave us a 65.4% return in only 9 months, which is an annualized return of nearly 92%. Now let's talk about stocks we bought this week. Now, a reminder, 90% of our portfolio is comprised of high-quality dividend growth stocks, but the other 10% is invested in under-the-radar dividend payers, which we're showing here. Now, these under-the-radar dividend payers are usually very small stocks with little information available in comparison to the large companies, and or a short track record. Therefore, they tend to be very volatile and very risky. High upside, but high potential for a downside. No one should be purchasing these under-the-radar dividend payers until they've done their due diligence. These stocks are not for the faint of heart. This week, we bought an under-the-radar dividend payer called Atcor, a medium-sized company that manufactures and sells electrical, mechanical, safety, and infrastructure products. Now, this screenshot on the slide is from Yahoo Finance. We don't have enough information yet on the company to give it ratings such as risk or dividend growth, so treat it as an extremely risky stock. Now, here are our ratings for the top 12 dividend-paying stocks this past week. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. This table includes their industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. On this slide, I want to show the components to my quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. As we said earlier, the other 10% are invested in smaller under-the-radar companies that have recently started paying a dividend. Now, all the stocks we bought this week, except for the one on the previous slide, qualify as high quality and are dividend growth stocks. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. And remember, earnings is just a fancy word for profits. And finally, the last quality component is financial health. Remember, historically, the best dividend growing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and higher yield this week are Discover, United Health, Evergy, Fidelity National, and NextEra Energy. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth. But that's not the way it works. You can't have the best of all worlds. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Discover, American Express, and Ameriprise. The companies with the best combination of recent dividend increases and potential of future dividend increases are Discover, Visa, United Health, and Ameriprise. Now, the holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. On this slide, we are looking at the stocks in our portfolio that have raised their dividends recently. 3 of our stocks raised their dividend by over 10%, being Cigna, Crane, and Elevance Health. And this is a new slide I've added. No, this is excuse me. This is the second week that we've done this. Anyway, so here is a look at the 10 stocks that make up the largest portion of the portfolio as of today, which is Sunday. Remember, we want to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Therefore, we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated and more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility, as mentioned before, often causes investors to panic and sell at the worst possible time. Our portfolio holdings are now at 82, down 1 from last week. That might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information from into the spreadsheet, which we do at least weekly and doesn't take that much time, fortunately. And here's the new slide for this week. We also started our technology portfolio. So because my students are enamored with tech stocks, on January 1st of this year, I funded a Fidelity account with $1,000 and we invested it into only tech stocks. Now, some pay a dividend, some don't pay a dividend. Remember, this is just tech, it's not a dividend strategy. Unlike our other portfolios, we are not investing additional funds each week. We are sticking with the original $1,000 investment. The technology themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. So far, the portfolio has increased 14.2% in a bit over a month. Now, it's probably not going to, I shouldn't say probably, it can't keep up that pace. It would be nice if it did. Anyway, the S&P 500 increased 4% over the same time period, but since this is a technology-only portfolio, a better comparison is with a technology ETF. The largest technology ETF is Vanguard Information Technology, and it's up 4.37% over the same time period. The best performers so far are Meta, which used to be called Facebook, Nvidia, CrowdStrike Holdings, Pure Storage, and Palo Alto. So that's the update for this week. We're trying other strategies too using real stock portfolios. Besides this dividend growth strategy and the technology portfolio, we're also running a high yield dividend paying stock portfolio and a portfolio that invests in stocks with the best competitive advantages, also called moats. Note that all stocks are eligible for this portfolio, both dividend-paying stocks and non-dividend-paying stocks. So in the comments, let me know if you have any questions or if you want to know more about the other portfolios. Also, let me know what other kind of investing videos you would like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as Twitter, X, LinkedIn, and my website, beatsastockmarket.com. Have a great investing week.